Hi, everybody. Good morning and welcome to your Cyber Insight interview series. Today we have Sean O'Rourke, and I'll introduce Sean. He's a leading cybersecurity liability expert. He's currently working with Coombs & Company, which is an insurance brokerage and consultancy, which is headquartered in New York. He focuses on small and medium businesses to help them mitigate the financial risk posed by their technologies and their data from both internal and external threat actors. He's spent over 20 years in the IT arena. The last 12 years, he's ran a technology firm that he co-founded. So he's a multifaceted guy. And this provides some unique perspective on the cyber liability market, potential disruptions that are faced by businesses in today's interconnected world. He is well versed in the growing cyber regulatory landscape, lending an experienced voice to the growing obligations that companies are now facing when it comes to cyber incidents. He sits on multiple boards of private companies, advising them on their cybersecurity, and he enjoys providing frequent talks on the business impacts of cyber events. He is also an avid Spartan and a CrossFit participant. I know how hard that is. I tried it, I almost died. So please welcome Sean to the program.
Morning, everybody.
Morning, Sean.
So Sean, let's start out with talking about the current state of the cyber insurance market. I've heard from a lot of folks that it's hardening. Can you tell us what you're seeing and explain that a little bit?
So hardening's an interesting way to describe it. What I will say is that the carriers are getting smarter about the risks that they're facing. Obviously, COVID has sped up the process or that learning curve, I should say, because it's exacerbated a lot of attack vectors that were already in place. And now all of a sudden, since you have a distributed workforce, people seem to have forgotten all the best practices that they knew while working in an office when they go home. The other part of that is that a lot of people aren't working on their work machines. They're working on home machines. And now that means companies have lost that ability to control what is being accessed, when, and how. And so I'm sure as many people here know, and I've done it, when you got to get something done, you learn to cheat. And by cheating, you open up security holes. So I think carriers are learning that. And I will say that I've begun to see premiums rise at a more steady pace than before. Though I will say cyber insurance right now is still artificially cheap because it's such a competitive market. So many carriers are offering the coverage that I think you're still starting at a lower price point than I, as somebody who comes out of technology, would be comfortable pricing it at if I worked for an insurance carrier. So that benefits insureds or the companies that buy the insurance. The other thing is that the carriers haven't gotten real strict about covering claims, except when you get up to the larger size. In the small mid-size market, especially on ransomware, they're just paying, which I think unfortunately exacerbates the issue. Instead of teaching companies sort of how to prepare to survive a cyber incident, they're basically covering it up because their bean counters are saying, well, it's cheaper if we just pay the ransomware than having to pay to have the systems and the data recovered. So yeah, I'd say hardening is an interesting word. I don't think they're getting stricter on the claims, on denying claims, but I will say from the premium standpoint, it's starting to go up.
And so with ransomware and different types of compromises that you're seeing, is there a difference in how they're handling the claims today? Have they changed some of the ways that they're interacting with companies?
So again, on a larger claim, yes, the carriers are doing more investigative work to make sure that what you put down that you have in place, whether it's on an application or if you've built your own policy working with the carriers, again, on the larger side. The small and mid-size don't have that option. They just fill out an application and come what may type of deal. On larger claims, I've seen carriers begin to investigate, make sure that what you said you have is what you actually had in place, especially when it comes to incident response and recovery. On the smaller side, for the good of the client, no. For the good of the carrier, I mean, to the detriment of the carrier, also no. They've just been paying, especially on the ransomware. The cyber fraud, like business email compromise or phishing scams that catch people when you do the fraudulent transfers, those I don't mind them paying out right away, because a lot of people are getting caught by very sophisticated efforts now because it's become organized crime or nation state driven crime. And so it's getting harder and harder for those who don't live and breathe technology every day to identify those suspicious emails. And even worse is that because the business email compromise, where a legitimate email system is being compromised and they're sending those emails, I mean, that's impossible to tell unless you've really set up multi-factor or multi-step authentication processes. And a lot of businesses, especially now, who are just scrambling to sort of stay in the game, they're not doing or hadn't done, and they're certainly not going to give it attention at the moment. So those types of factors are being paid out pretty quickly. Network compromise, long-held data exfiltration, those across the board do require more investigation because the insurance carrier has to determine what the regulatory and potential legal aspects will be. So those are long-term claims, and I don't think anybody's really done a good investigation or data mining on what carriers are doing on that. So I just have a gut feel. I don't have anything really specific to back up that I think carriers are taking longer times with those, but necessarily so because it's a much longer process.
Yeah, that's interesting how this whole COVID situation not only has impacted the world from a financial perspective, but is changing pretty much everything in terms of how companies have to be even more hyper vigilant. For those of the folks that perhaps were not on some of our other calls, I think maybe it would be good for us just to explain what cyber insurance is as well, and talk about what a cyber insurance limit is, both the aggregate limit and the sublimit. So people have if we start to talk about business compromises, availability compromises, they understand that that's related back to either a denial of service attack or a ransomware attack and things like that. Do you want to just take a moment to do that?
Sure. So cyber insurance is just like any other insurance policy. It's essentially a backstop for after something happened, where, again, I would like to see it be a little bit more proactive, is that they hold an insured's feet to the fire to sort of do things right, but they're not doing that at the moment. And currently, the limits are still based on the amount of sales that you are doing, even though that doesn't properly equate to the risk that is posed by data and cyber systems. And I'll give you an example. I won't give you a client example, but I'll just give you a general example. So the data that you may hold on your customers, to you, is really only worth the value of the contract or the agreement that you have with your client or customer. However, the data value to your client customer could be exponentially higher, simply because of the potential damage to them if that data is ever released or made public or compromised in any way. And so insurance carriers, to their credit and to the detriment of the insured in this case, have said, you know what, we're not going to cover anything that should be specified or delineated in a terms and conditions or other types of contractual form. So right now, I will give you an actual practical example. I have a client, a medical billing client. They are they are in New York City. They do specialized surgery clinics and different types of operations. So the numbers that they're dealing with are in the 5 to 6 figures on a consistent basis. Well, obviously they have access to a lot of financial and a lot of health information. So that makes them a high risk. And the value of that information to the particular owners of that data is at least 3 to 5 times the amount it is worth to the medical billing company. But I was only able to get them $5 million in coverage because that was the appropriate number according to the carrier based on their sales. And that's where a lot of insurance, that is old school insurance thinking, is that the amount of sales you do is the amount of risk you have. And that is not true when it comes to data and your cyber systems. That number, like I said, is much higher, but carriers are saying that is a contractual detail, and that's where it should be settled in terms of your exposure. And the carriers aren't going to essentially give you a backfill coverage for that type of exposure.
Yeah, it's interesting. We also have, so for those of you who are not familiar with the courses that we teach, cyber insurance is one of the modules we cover. And we are talking about limits adequacy, how to quantify these limits based upon what kinds of exposures you actually have, so you can determine how much insurance you should buy, versus what Sean was just talking about is how they are using what I call the Fred Rogers method, for a lack of a better reason. So we actually did a quantification of a company that is in the e-commerce space. They also have a brick and mortar subsidiary. And what we saw was that they were underinsured by 200% on the aggregate, and that on the ransomware, they were underinsured by over 1,000%.
Sure.
So they really were underinsured. And, you know, with this COVID happening, people really should take a look at that and say, you know, what does this mean for my business?
Yeah, to that point, to further answer your previous question, so there's a per occurrence and there's an aggregate when you get an insurance policy, and the de facto limits are 1 million, 2 million. So what that essentially means in plain English is that you can have, let's say, two claims worth $1 million per policy year. And so each claim could be $1 million. You could have 4 claims for 500,000, and that $2 million is the limit, the upper limit that the insurance carrier will cover you for within a policy year. The ransomware number, or cyber fraud or cyber extortion, it really depends on how the carrier defines it. That number is usually somewhere of the order of 10% of the per occurrence limit, with no numerical limit until you reach the 2 million aggregate. So again, you can have 20 instances of a $100,000 ransomware attack. Part of the problem is, to your point, Ariel, is that the larger the company, the more known it is to ransomers, which means the larger the number is going to be for the ransomware attack. It is not uncommon now to see 7-figure ransoms on upper mid-size and then larger businesses. And so that is one thing that you can sometimes negotiate, even if you're just getting an off-the-shelf coverage. That is one area where you can negotiate if you think you might suffer a higher per incident ransom event.
Mm-hmm. Right, exactly. Just a reminder to viewers, we take questions at the end. I forgot to say that in the beginning. So if you have questions, type them in the chat, because that's how we will start to go through your Q&A section. So thank you for that. So let's switch over to looking at, you know, what are carriers doing to entice companies to improve their cyber resiliency?
So in the upper end, they're doing a lot. They're working with companies directly and allowing them to craft their own, essentially, cyber insurance policy. But the carriers are providing third-party audits of the infrastructure, and to make sure that they're going to insure somebody who's actually doing things the right way. On the small to mid-size structure, they're really not doing anything to encourage them to do things properly. In fact, I was on an interview last night, and I did say that an insurance policy is basically a cheat code to not do things the right way for post-breach response, because the carriers aren't holding the insured's feet to the fire. They're not asking, or they're not penalizing them if they don't have an incident response plan. They're not penalizing them if they don't have some sort of redundancy or systematic backup of not only the data, but their systems itself. They're not penalizing them if they're not training their employees on how to spot phishing attempts, or they're not penalizing them if they don't lock down the types of websites they can go to. So basically what the market that I primarily focus on, because it is such an underserved market for people who understand both the technical and the business risks, is that the businesses are looking at the insurance policy as a way to get around doing any of this work. And until the carriers sort of change their mindset, they'll continue to do that, despite what I tell them, that it'll make their lives easier if they do this proactive work. Now, I give people a little bit of a pass from the end of March through maybe June, but come July, when things started to sort of normalize to a certain extent, even in hard-hit areas like New York City and whatnot, people have to get back on it, because they now have a different infrastructure in place that really needs some post-breach attending and plans. And that's where really most of the financial damage is done. When you look at the people who fall under regulatory fines or civil lawsuits, it's because the business side wasn't prepared. It wasn't because the IT didn't respond properly or didn't have the proper systems or policies or procedures in place. It's because the business side didn't. And that's why when I left the day-to-day of the IT world, I started trying to focus on the business side to sort of let them know, no, this is no longer an IT problem. You can't just push it off to them. You are the ones responsible for making sure that your company survives an event, not the IT department.
Exactly. And that's the whole purpose of the courses that we've created, is so that we raise this level of awareness, so that people do start to understand what their responsibilities are.
Sure.
In cybersecurity. And I just found it so interesting what you said, because you would think that there'd be some type of enforcement, there'd be some type of ability to come, and I think this will happen eventually. Maybe it will happen in the next few years, as they'll start to understand that it's not going to be a sustainable market for the insurance carrier if they're not actually going back and enforcing the levels of security that the client had said that they had in place, and simply just decided to be disingenuous in their application process because they wanted the coverage and they needed the coverage, and nobody really checked it. So this checkbox mentality of saying, in Hebrew we say yehi yeh beseder, it means everything's going to be all right. It's like, well, that's not really true. It was like one of the first things I ever learned, and it was like one of the first things I said, well, that's ridiculous. So let's segue into like the regulatory part of it, right? Like, so say, as an example, that you've got your policy and you really don't have the incident response in place well, and the business isn't really being proactive in terms of the cybersecurity program. How do you think the laws that we're seeing now, like New York State Part 500, we're having our first litigation with First American Title, right?
Yep.
Over New York State Part 500. How do you see that playing into the insurance discussion?
So two ways. First of all, every state has a breach notification rule. They're all different. They all have different terms and conditions. So if you're a multi-state business, you've got that headache with which to deal. You must know what your responsibilities are when it comes to a breach, and who you have to notify, what kind of monitoring service you might have to put on or provide your customers or your clients. Part 500 actually is the most reasonable regulatory framework out there, I think. That includes GDPR, that includes Brazil's new privacy policy, which is kind of funny because of how you're able to skirt around it and the loopholes in it. But I think Part 500, that's the framework that I use when I consult with my clients to sort of tell them what standards they need to meet. Now, obviously, California has CCPA now. Nevada has their own. South Carolina has their own sort of Part 500, but for insurance companies and those in the insurance business. Every other state has something brewing in their legislatures to relate to cyber to sort of further strengthen it. I think the other half of it, and then we'll tie it into the insurance, is that if you look at the Office of Civil Rights, which oversees HIPAA fines, the Office of Civil Rights has set records almost every year for the last 5 or 6 years in terms of the number of fines and the amount of the fines issued. I think states will look at that. They'll look at how the enforcement action in California and New York go. New York also has the new SHIELD law. And they're going to start to see that as a source of revenue. And most states right now are desperate for revenue, and a desperate state is a dangerous entity because they will do things that are outside of just being practical. They will do things that will help them raise money. And where it ties into the insurance is right now in the US, the insurance policies and almost all cyber policies have coverages for not only regulatory fines, but for the legal expenses to defend against regulatory action. So in that event, again, even if you don't do things right, which is what's going to cause the majority of the pain from a regulatory and a civil standpoint, the insurance right now is still going to cover it. Now, they may try to deny a claim or reduce how much the coverage is, but that's going to be difficult if they're not enforcing or if they're not doing follow-up to ensure what you put down on an application is exactly what you have in place. And to your point, you mentioned it being disingenuous on their application. I never allow a client to lie, and that's where having my technology background really becomes helpful, because I know when they put a checkbox on something and I've talked to them, I know they have either no idea or it's wishful thinking, especially when it comes to encryption, what they do with their data backups. And I make them change the application, and they have never gotten a higher premium because they've changed the application to say, nope, I don't encrypt data. Nah, my backup is once a day instead of every hour or on a regular basis. Yes, I have a firewall. Yes, I have AV, but I'm using free versions of antivirus and whatnot. They've never been penalized for that when it comes to the premium. And luckily, I've never seen any of them be penalized when it comes to claims. So while the regulatory action is going to get stiffer, it's going to become more common and whatnot, I don't see the insurance really changing yet. But 2021 will be a different year when they sort out all this 2020 mess.
Mm-hmm. Yeah, speaking of the OCR, they just issued a press release yesterday that Premier Blue Cross has agreed to pay $6.85 million. Yeah. Now that's the second largest settlement, Anthem being the first in 2018, first largest settlement. I think what's happening too is that, you know, you mentioned the Insurance Data Security Act, South Carolina, 10 states have adopted that. One of the issues that we face, and we actually are addressing this in our program, is how do you understand if you've got 4 different regulations that have very specific types of either breach notification or security controls or vendor risk management programs? How do you pull them all together to understand you're not being redundant across different silos of your business and spending 2-3 times the money trying to do it? And that is a huge problem. So understanding the impacts of these regulations across the controls, across vendor risk management, across cyber insurance, and everything is really key to having an effective program. And it's a business issue. It's like
It is.
we have to tell them what to do
Yeah.
from the business. Otherwise, we're going to sit there and we're going to spin our wheels and go crazy. So I find this topic fascinating, by the way. I absolutely find this topic fascinating because it's such an immature market and everyone is like trying to figure it out. And it's like, and so the more that we can start to piece it together for ourselves, the better we're going to be. So in your experience, what do you see as the prevailing attitude towards cyber insurance today?
On the small to mid-sized market, I don't want to pay another premium for an insurance that I don't think I'm ever going to need, which I think the statistics are backing up that that's not true. Every small mid-sized business's argument is, well, I have nothing that they want, or I'm too small. And I'm like, it doesn't work that way anymore. So that's the primary attitude until it's too late. I can't tell you how many calls that I've received that said, hey, I think we have ransomware, or we just transferred some money out and it's actually to the wrong account or to a fraudulent account. Can I get a policy to help protect me? And I'm like, no, the insurance doesn't work that way. You can't buy it after the fact and then put in a claim immediately. That's fraud. And so when it comes to that, it's that's the prevailing attitude. And I do my best to really talk to people about the proactive nature that a business must attend to. On the upper scale, they've all got it. The upper mid market to the enterprise market, everybody's got it. It goes without saying now that it's a necessary policy. It's got to be part of your insurance portfolio, and they understand because they have the teams that are able to do the financial analysis, the legal analysis, and whatnot. And they're like, oh, yep, this is going to cost us a fortune if we don't do it right. So let's go get it. And so that I think the market. I forget the last statistic that I read, but I think when you're talking anything over $100 million, I think you're looking $100 million in revenue. The adoption rate is somewhere in the 70 to 80% range. Below 100 million, and definitely below sort of $50 million, that adoption rate is in the low 20s. Maybe it's at 30%. It really depends on whose numbers that you believe and what data set they're looking at.
Yeah, I see the same thing. I think you're right. I think those numbers are pretty accurate. So when you talk to prospects about cyber insurance, what are some of the things that you are trying to get them to understand fundamentally, and how do you present the coverage to them?
Well, fundamentally, that it's a business problem, not a technology problem. And the insurance is there to cover the business, not necessarily the technology. Even though it will cover recovery of the technology, it's not going to get you new computers because the ransomware essentially bricked a computer. Obviously, that's the big Mondelez headline. What everybody missed is that the cyber insurance coverage covered the NotPetya attack. It didn't cover this. They were trying to get coverage on their property for the computers that were bricked because of the virus, and they didn't want to rebuild them, so they just wanted to replace them, and they didn't want to do that. The insurance carrier didn't want to do that. They said there was no physical damage, and it's very much like the business interruption argument that a lot of companies are trying to make when it comes to COVID. And your business interruption is based on physical damage. Well, they've tried to create torturous arguments as to why COVID has become a physical a physical event. And right now the courts aren't buying it. The language is pretty clear. And just because there was a civil shutdown doesn't mean there was a physical incident that happened. So, that's sort of the nature of what's happening at the moment along those lines.
Yeah. So who are the people that typically are the decision makers and the buyers? How are you seeing that?
Well, it's very funny. In my market, again, the small mid-size, I'm talking to the people, the business people are calling me, but it's kind of funny that in some instances, I'm getting calls from the VP of IT or the head of IT, or I get calls from one of my old compadres in the sort of the outsourced CTO and IT world. And they're the ones calling me saying, hey, my client says they want cyber liability insurance. What can I do an introduction to you? And when I get those calls, I know exactly what the thinking is on the client's part. Well, this is an IT problem, so I'm going to tell them to go get me the insurance. And that starts an interesting conversation, an interesting process, which takes much longer than when the business people come to me. So usually I'm dealing with the people who are already paying premiums on their general liability, their professional liability / E&O, or any other policy. Those are the people who are coming to talk to me because they look at it, okay, this is going to be another premium, so that falls in my bucket.
Makes sense, yeah. So there's directors and officers insurance, and there's gaps in what cyber will and will not pay when you're looking at property and casualty and D&O. Do you want to just talk about that for a second so people understand the big differences?
So, so on the D&O side, the D&O is an open wound right now that has yet to figure out how to heal it. Right now, there is a lot of exposure on the directors and officers level when it comes to cyber, yet court cases are still settling out what that exposure is. Cyber liability insurance does not cover directors and officers, does not cover executives, does not cover employees for potentially personal liability if somebody wants to come after them personally. It will be interesting. I'm not sure if everybody saw the blaring headlines, ransomware causes first death in Germany. Ransomware did not cause ransomware did not cause that woman's death. What happened was there was a ransomware attack on a hospital. The hospital systems went down. And in so doing, they had to divert a woman who was having a cardiac or a respiratory event to another hospital. She subsequently passed away, and the headline blamed the ransomware attack because they said they were under the assumption if she had made it to that hospital, that primary hospital, she would have made it. There's no evidence that I've read so far that says one way or another that that's the case, but it made for good headlines. So what's happening now will be interesting. That's obviously German law, but if something happened here in the United States, there's nothing that says that that woman's family couldn't sue the hospital and hospital administrators and people in IT for that. And what insurance would cover that based on a ransomware attack would be up in the air. Because D&O does not, directors and officers covers them, but usually for their responsibilities as a director and officer, not necessarily in the day-to-day running of an IT. So that remains to be seen what's going to happen. And it'll be interesting to see if it plays out. There may become, I suspect there will be a cyber portion of D&O at some point, but nobody's figured out how to really make that work.
Right, that's a very interesting point. So it's really important for people to understand all the different aspects of what the policy is covering and not covering.
Yeah.
And Aon announced last year that D&O derivative actions. Cyber events are now among the top 3 triggers for them. So it is becoming a huge issue for the directors and officers. So in terms of what would you change if you could wave your magic wand about cyber insurance?
On cyber insurance, I would change the application. That was the first thing I would do. If I was in an insurance carrier right now, or if they hired me on a consultative basis, hint, hint, insurance carriers watching this, I would go in and I would gut the applications for just off the shelf cyber insurance. Obviously, if you can customize, if you self-insure, if you have a captive or whatnot, you could pretty much work with an insurance carrier to customize your own. But for off the shelf, I would change the application process, and I would weight particular answers on the risk exposure that presents to the carrier. The second thing I would do is, if I'm a carrier, I don't know if you want to do this internally because it may create too much of a head count for them, but I would figure out from a claims perspective or even pre-claims and pre-event how, to your point, you would go about validating that your insureds are doing the right things, or at least are on the road to doing the right things and have the right attitude about cyber. Because look, if you're going to continually pay out ransomwares and you're going to continually pay out for fraudulent money transfers and for denial of service attacks and other events of that nature, well, then you should make sure that people are doing and taking the right steps to minimize those events. And so from that perspective, I think those are the 2 primary areas that I would start. A new application so that you can better gauge what is risk or risky about an insurance environment. And the second thing is I would start validating what they're doing, whether that means asking for documentation, which an AI can scan easily, or even providing the documentation or templates of that documentation and making them submit it to you in some form or fashion. I did see somebody in the chat had mentioned that insurance carriers were offering pre-breach coaching and obviously post-breach teams and whatnot. And that is true, but that is not true of all size policies. So it's really a factor of what your premium is, what size of your company you are, as to the access that you have to those kind of modules when it comes to cyber insurance.
Yeah, so we'll now pivot over to some of the questions.
Sure.
So from Debbie says, cyber insurance is continuing to be a big opportunity for insurance companies when offering the insurance premiums to large financial institutions to proactively secure their crown jewels like their call centers, data centers. How is it different when you're looking at it from a cloud perspective? And how is it different between different industries?
So I've not seen real much distinction between industries. I think carriers they look at the amount of data that you have, and that's what they're using to sort of level set what the risk is. Now, the larger you go, the more expansive and the more interested they become in terms of setting up a real audit of your infrastructure and identifying where risk lies. And but when it comes to, and I forget what the wording was because I want to get this answer right. Can you read the part of the question again? Oh, from the cloud perspective. So the cloud is interesting, the way cyber insurance is working on that piece. There is dependent business interruption now as part of the really good cyber policies. That means if your business is dependent on a third party and they suffer a cyber attack that knocks that system or the access to that system out, you can claim a business interruption under your existing cyber policy for that disruption. Obviously, it's got to be a certain amount of time. It's got to reach a certain level beyond your deductible and whatnot. But let's say all things being equal, there is that ability to say, hey, my entire business runs on Shopify and Shopify went down for a week, then you can claim business interruption if you have that type of coverage on your cyber policy. Obviously, the larger the company, the less inclined for me to think that they are solely dependent on a third-party system as opposed to a hybrid cloud solution or a private cloud solution. In which case, if it's a private or even a hybrid, that would fall under usually their general business interruption piece, but they would have a cyber business interruption provision as well. So it would fall under one or the other of that. The smaller players that are dependent on third-party cloud providers directly, there is a dependent option, but you have to make sure it's part of the policy that you're getting.
Exactly. And so what we did see also, and this is, I think, a great question and a great answer, is the distinction between dependent and non-dependent business interruption is a new concept that just came out this past year. And so we've incorporated that into our program as well. But understanding it from a cloud first perspective, going back to making sure you understand what digital assets you have and are they on premise or in the cloud? That is a critical piece of this. If you don't have that level of understanding, then you're going to miss this one.
And that's where I would change part of the application process, is that question is not asked.
No.
That question is not asked about cloud, about is it a third-party provider, is it private, is it a hybrid, and how dependent your business is on that. That's just not delineated or asked in most general cyber applications.
Yeah, I think the application has to go more into the digital asset and understand what the heck they're insuring. Because if they don't understand that, then they're not going to be able to price appropriately. They're not going to be able to have good actuarial analysis. They're not going to be able to provide discounts for people who have better controls in place than others and higher risk or lower risk than others. And it's just not going to be a sustainable market, in my opinion. So we have another question from Niv. He says, the larger the company, not only the larger the risk, but they can afford all the extra business perks such as good insurance. It is very difficult for many smaller companies, especially during bad times, to find additional funds for those things. When it's not too tangible, as Sean is saying, this is the real risk. This is where real risk management comes into play. You need to take some risks to succeed in business.
I totally agree. Look, the premium is the premium, but you can factor that into your accounting. You pay it over time. Most of these are not pay all in full. So you just budget it in, even on the tight budget. It's better than assuming a risk assuming an out-of-pocket expense on this risk that is increasing. And in some instances, the cyber risk to you is greater than a general liability risk or even an errors and omissions risk.
And from Urs, very similar to what we just heard from Debbie, in terms of the insurance coverage based on the increasing dependency on third parties, as well as the cloud. So that's another aspect that I don't think is really understood well either, with just general third parties.
Not at least not by the carriers.
No, and
the insureds probably understand it at a gut level much better than the insurance carriers understand it.
Yeah. So what we are teaching in vendor risk management is that you can't treat all vendors the same. You have to look at cloud providers different than you would look at someone who's a service provider like McKinsey, who's coming in and implementing your SAP. They're not the same kinds of risks. Right. So this is really important to understand. Thank you, Urs, for that question.
Well, just talk to all the Microsoft now 365 customers. When Microsoft had that outage a couple days ago, the outage was, and
that was painful.
it was painful because it wasn't uniform as to what wasn't working and what was working. It was like a cascading effect. It's almost like they picked up one domino and knocked down two more as they fixed it. So
exactly.
For people that are dependent on emails and on multi-factor authentication for the 365 systems, and it was working for a moment and then it would break and it would work for a moment. I mean, that kind of stuff is frustrating, but it's not an outage. It's not something you would do at an event. But let's say all of Azure went down. Now all of a sudden you're talking about something that could potentially affect your business in a very, very serious way that would prompt a business interruption claim, but only if you had cyber. So.
And where that kind of also leads to another discussion is on what they call risk accumulation, where carriers are insuring across these dependent business risks now. And well, what if 80% of their portfolio is Azure and Azure goes down? It's like, is that sustainable for the carrier? Probably not. It's like, it's about risk diversification and a portfolio analysis where they should be equally distributing their risk across AWS, Azure, Google Cloud, whatever, right? So there's so many aspects of this that have not been flushed out properly by the carriers. Phil is saying, what about cyber professional E&O?
There's just E&O. There's no real cyber E&O, right? It's just E&O. The cyber insurance is for events, cyber events. Again, I ran an IT firm for 12 years. We had E&O, but we also had cyber. We also had general liability. We had, I forget. I know we had two more elements of the portfolio, but I don't.
Property,
out of it for,
casualty.
Yeah, and it was just, but cyber is about events. The E&O will cover your line of business. Now, it's a good question as to where you delineate cyber insurance from E&O for a technology or a cyber company. That can get a little gray-ish. But typically, I mean, if you have a good broker or you're dealing directly with the carrier, you should be able to clearly define where that line is drawn between E&O and cyber insurance.
Exactly. And that's one of the primary jobs of the broker, to understand and explain to the organization that's considering buying it. Another question, which is great from Urs, is what about smart devices and sensors? We have a new law in California that is specific for IoT.
Right.
So do you see different types of coverages starting to address that, particularly business versus personal or anything like that?
So yes and no. Let's take Starbucks for example. You're in a Starbucks, you get on their free Wi-Fi, you don't use VPN, and you decide, you know what, I'm going to check my bank account because this seems like a good time in a crowded Starbucks and whatnot to do that. If there's somebody there who's sniffing the Wi-Fi signal and they get your bank account, you can go after Starbucks. There's nothing preventing anybody from suing anybody, let's be honest, here, but you're not going to win. Even if there's a default, or even if Starbucks didn't patch, let's say something in their Wi-Fi, their WAP, I don't think you're going to win on that perspective. That said, I also don't think, well, Starbucks is a weird example because they're so big, they'll have a policy probably to cover them. But let's say you're a local mom and pop coffee shop. I doubt you're going to have anything within any of your insurance policies that are going to cover the legal expenses and the potential settlement expenses from something like that. IoT is still a bit of the wild, wild west when it comes to the technology itself and the regulation of it, or the expected outcomes or security provisions within IoT, and insurance has not addressed that in any kind of uniform manner. So I would say, no, there's nothing out there, but there's also such a gray area. Again, you may get sued, but if you're the provider of that free Wi-Fi, but you probably win in the end, but it's still going to cost you money. So that's why, I mean, I understand the attractiveness of free Wi-Fi and whatnot, but unless you make sure you're taking care of it, you're having somebody watch it, then I'd say it's better not to offer IoT. And don't get me started on stuff like Beacons used to do, or what they're trying to, or retail is trying to do with Bluetooth now on promoting things. There's some malls in South Korea that use facial recognition to track people through the stores and whatnot. That won't happen here anytime soon, but it's out there. And if retail is really desperate, they'll try anything to make a sale. So,
yeah, that's not good. Vlad is asking that he's heard that insurance carriers are starting to recommend certain cybersecurity vendors for lowering premiums. Is it a common practice? And if yes, how are carriers building the list?
So I think it's more common on the upper end of cyber insurance. What I have a real problem with any cyber carrier requiring a specific vendor is that vendor is not familiar with the infrastructure. And for all my IT folks out there, we have our own flavors and own ways of doing things that aren't wrong. They're just different. And so now all of a sudden you're going to have a third party coming in who has their own way of doing it, and they're going to start pointing at the current IT team, whether it's internal or outsourced, and saying, well, no, you need to do it this way. You need to do it that way. And that's just going to cause massive headaches. I like the idea of pre-breach coaching, or pre-event, I should stop saying breach, pre-event coaching and post-event teams, as long as you do it right. And don't look at the Capital One deal, that Capital One ruling on the privacy of their breach response. Capital One was stupid the way they did it, and they deserve to get the ruling that they got. But I don't want insurance carriers getting into the business of telling companies you have to do it this way, because that's not going to work.
They have enough things that they have to deal with.
Yeah.
Let's have them focus on what they do better. Joe is asking, Sean, you mentioned it earlier, but is the majority of the mid-sized market, or is it mainly sought after by large companies seeking third-party loss coverage as well to defend organizations from consumer class action litigation and funding a potential settlement in the event of a cyber incident or data breach, which would cover the defense costs, forensic costs?
So that's typically a higher end. Smaller folks aren't thinking about that necessarily, but as an insurance carrier, a lot of the carriers on the small to mid end are going to say that is a contractual detail. That is something that they're not going to cover above and beyond a certain number, because that is something that you should have in your agreements, your third-party agreements, laid out ahead of time. My favorite expression is limitation of liability. Find that in any agreement that you sign, and you'll know exactly what your limit's going to be. Again, doesn't mean you can't sue somebody for more. It just means you're more than likely going to lose if that limitation of liability was written with any kind of care. So from that end, yes, it is available, but it is usually on the higher end. Obviously, after the Target fiasco and some of the other third-party breaches that caused breaches for the larger companies, that is being looked at more. But that is, I take that on a case-by-case basis because that takes a little bit more effort to get in place. Because what's going to also happen is that if the larger company is smart, they make the service provider name them as an additional insured on their cyber policy or some other policies, so that that takes primacy over their own policy should anything happen. But again, there's going to be limits on that.
Right. So I think we have time for one more. Jason is saying, as a consulting company, insurance providers are now controlling the governance through panels and approved providers. What recommendations do you have to organizations to get onto these panels? Also, what are your thoughts on consulting firms becoming cybersecurity insurance providers as well?
Okay, I'm going to take the last question first. Don't do that. Do not do that. Look, if you want to represent or because, okay, for those who aren't familiar, there is a cottage industry at the moment of people coming to IT firms to offer them a new revenue source, and that being cyber liability insurance. These policies, even if they come from very well regarded or reputable insurance carriers, they're not the same as going directly to the carriers or through a broker to get the policy. There are different limitations on there. In fact, I saw one where it was first party coverage only. What didn't include third party, and the third party coverage is more important than the first party. So we're not even going to go into that at the moment. If you want that as a particular revenue line, you got to make sure the way the relationship is set up, because you do not want to be responsible should a claim be rejected of your client coming back to you and said, hey, but you told me that this policy was going to cover me and now I have a rejected claim, and then they sue you. Don't get into a line of business that is, from my perspective, when I had my IT company, my partners and I decided a couple years before I left the day-to-day is that we were going to start recommending that our clients get cyber insurance and explain to them why. And if they wanted it and they didn't have a broker to go to, well, then we could provide them a broker. But for the most part, we recommended that they get it. We didn't sell it. You're not going to make a ton of money on this, so why bother with the exposure? As for getting on the panels, that's kind of tough. There is a process that you can go through to be vetted and be added to those panels for carriers. I'm not really sure, unless you want to make that your model or you're already in there and you sort of built your company around that model or that line, or you have a particular division of your company that's built around that model. It's kind of an inconsistent model, and then you are the insurance carrier dictates your rates and what you get paid. And you have to be responsive basically 24/7 on there. So from that perspective, if you want to do it, I say go for it. I have no inside knowledge on how the panel application actually goes because I've really never investigated that portion of it. But I do know a lot of people that do it for a living. Obviously, cyber lawyers are now a big deal. That's the real growth area, are the lawyers, because lawyers are now leading these breach responses because they want to keep as much under attorney-client privilege. So if you're a lawyer and a cyber lawyer, I can see doing that. On a technology side, again, if you think you can build that model into your business, yeah, I'd say go for it. You can probably go to carrier websites or just give the carriers a call and start doing investigating and figure out how to apply to get on to be one of the panels.
Terrific. Sean, thank you so much.
Oh, thank you.
Terrific. I really appreciate you doing this. Everyone on the call today, thank you for your time. Of course, this will be recorded and available. We'll be sending out the links in the newsletters as well to everyone who's on the advisory board. Feel free to share it with your colleagues and your peers, and join us again on another program in the next couple of weeks. And have a great Wednesday. Thank you.
Take care, everybody.
Bye, everybody.
Thanks.